Hey everyone, it's Erich Reimer. I'm here today to talk about the difference between mutual funds and ETFs. We've seen in recent years how ETFs have become a very popular financial instrument for many people who want to be able to invest in essentially a mutual fund like instrument where you have the benefits of diversification, we have the benefits of being able to invest in a lot of different companies, or even in many cases, financial instruments that you otherwise don't really have access to in a one size fits all way, while also being able to very quickly invest, see how the price of the instrument goes during the day, and to quickly dispose of it as you wish. Mutual funds have been around for a very long time and are still pretty gigantic out there. This is for many reasons. Many, for example, 401k plans only allow you to invest in certain kinds of mutual funds, etc. Many mutual funds out there are actively managed. They allow people to place their trust essentially in a financial manager, some investment manager who they believe has exceptional insight into the market, or to place their trust into a strategy that still retains some human guide towards it. Many ETFs out there are passively managed. Almost all of them are, even though some of them now have increasingly been able to have actively managed options as well. And so for an ETF, essentially, you are placing your money in an instrument that allows you to bet usually on a kind of strategy. This could be a particular sector within the market, a particular size of company, a particular set of companies that share a common characteristic. For example, there's ETFs out there for um, uh, low PE companies, for social responsibility companies, for every kind of thing imaginable out there. And so this proliferation of ETFs has now resulted in there being trillions of dollars of ETFs out there. I mean, there's some big players that dominate the ETF market. You can see, for example, iShares, BlackRock, etc. They have a really big offering of ETFs and have really specialized in it. There's still some out there that are just as big. Vanguard has a lot of mutual funds as well as ETFs. State Street, similar. State Street actually has one of the oldest ETFs out there in SPY, so for the S&P 500. And mutual funds also being of a different time, they have a lot of characteristics you don't really find in ETFs. Now, both ETFs and mutual funds have fees, but mutual funds still, even to our modern day, will have various extra fees. These include load fees, so the kind of commission to buy a mutual fund, transaction fees, and just a whole other variety of fees. And on average, to mutual funds, because they usually are at least to some degree, actively managed with people essentially there trying to play their hand in the market. They also usually, therefore, have much higher expense ratios. And even though it may initially not seem like a big difference, whether it's a 1% expense ratio or 2%, when you think of over many years and over a lot of money, um, having a 1.5% expense ratio when there is a similar ETF that has essentially the same strategy out there with just a 0.1%, 0.05% expense ratio. That is actually a lot of return. I mean, that's more than double what the 10-year treasury yield is right now. So you think that kind of difference matters. And it does. And so for ETFs, they are often very easy to access. They are very easy to create. They often, um, they're also very easy to fail as well, usually because they're the size of their funds dwindles to too small an amount. Mutual funds, I feel generally you don't see tiny mutual funds out there due to the cost needed to run any kind of mutual fund. And now there's a lot of ETFs out there, and they're starting to get up to the number of mutual funds out there as well. So they're starting to become comparable. But for many investors out there, they like ETFs because they're really easy to invest in. You just buy it like you buy a stock. Um, you can sell it anytime. You can see how its price moves during the day. While with a mutual fund, often it takes a little bit of time to buy and sell. Usually it's only a once per day kind of thing. You can't really see clearly the price of the mutual fund during the day because the mutual fund often does not have to report the price during the day. And that's why people like ETFs, because in our modern high-tech world, it's very easy to just go on your phone and buy and sell entire swaths of the market, and ETFs allow you to do that. And those essentially are the key differences between mutual funds and ETFs. Mutual funds are much more, um, they're much slower. They are actively managed. They have a lot of history to them. ETFs are relatively new. They are passive. They have a set a guide of rules, and generally follow those. They are quick and nimble. You can buy and sell them and see their price any time of the day. And there are some, on a broader level, there's interesting systematic issues about the prevalence of ETFs nowadays. Some people say it creates a market risk, people just putting money into broad-based index fund ETFs and not really thinking about what they're investing in. But that's a topic for another time, because this is just a basic introduction to what ETFs really are and how they differ from mutual funds. And so, happy investing out there.